Welcome back to the deep dive. We have got a really interesting one today because we're looking at a company that everyone thinks they know.
Oh, yeah?
You see the white duck, you hear the quack, you think, supplemental insurance. Simple. Right. It's practically woven into the fabric of pop culture.
It is. It's arguably one of the most successful branding campaigns in history.
Yeah,
You say the name, people just hear the mascot.
exactly. But today, we're going to do what we do best. We're stripping away the mascot, ignoring the commercials, and staring directly into the engine room of Aflac. It's Thursday, February 5th, 2026. Aflac just dropped their Q4 2025 earnings report yesterday afternoon, and I've spent the morning going through the transcript, the spreadsheets, all of it. And I have to say, the narrative here is, well, it's complicated.
Complicated is putting it politely. If you just glance at the headlines, you are going to be scratching your head.
Right.
You have sales skyrocketing in one specific geography, yet total revenue is down almost double digits.
And a massive beat on revenue expectations, but then they miss on the actual profit per share. It's a messy report.
It's a total paradox.
It feels like a tale of two cities, or maybe a tale of two currencies.
That is exactly what it is, and that's our mission today.
Yeah.
We need to unpack this Q4 report to understand that disconnect. Why is Wall Street reacting the way it is?
Yeah.
What is going on with this massive divide between their U.S. business and their Japan operations? And honestly, if you're an investor, you need to decide if this company is a growth story or just a giant ATM machine spitting out cash while it slowly, shrinks.
That is the big question. Well, let's start with the immediate numbers, the rip the Band-Aid off moment. The report just came out. What's the headline that had traders moving this morning?
The headline is a miss on the bottom line. Aflac reported adjusted earnings per share EPS of $1.57.
Okay.
Now, the Wall Street consensus was sitting at $1.69, so they missed by 12 cents.
And we should pause there because for a boring, predictable insurance company like Aflac, a 12-cent miss is actually pretty loud.
It is.
Usually these companies manage their earnings to the penny. They're supposed to be steady eddies.
Precisely. A miss like that typically signals that something broke in the model. Either expenses got out of hand or claims people actually getting sick and filing were higher than their actuaries modeled.
And spoiler alert, it was a bit of both.
A bit of both, yes.
But then, and here's where the confusion sets in, you look at the top line, the revenue, and it's a totally different story.
A complete flip.
They reported, $4.87 billion in revenue? The expectation was only $4.45 billion. That's a huge beat.
A massive beat. Over $400 million.
So, hold on. I'm looking at these numbers trying to reconcile them. How do you beat revenue by nearly $500 million but still miss on profit?
Yeah.
And more importantly, if they beat revenue expectations so badly, why does the report say revenue is down nearly 10% year over year?
Welcome to the optical illusion of multinational accounting.
Yeah.
You have to put your detective hat on here. Yes, they beat the expectation of $4.45 billion. But last year, in Q4 of 2024, they did $5.4 billion. So the business effectively shrank by roughly 9.9% in dollar terms.
That is a steep drop-off. And I see here net earnings fell from $1.9 billion to $1.4 billion. That's $500 million of profit just gone compared to last year.
It looks bad on paper.
Yeah.
But this is where we have to talk about the yen. We cannot talk about Aflac without talking about currency.
Okay.
The average yen to dollar rate for this quarter was 154.20. That is significantly weaker than it was a year ago.
Right. So because Aflac does such a massive amount of business in Japan, which we'll get to, they earn in yen. And when they convert those weak yen back into strong dollars for their report, it looks like they made less money.
Exactly. It's a translation loss, not necessarily a core business loss. If you look at what Management President Frederick Crawford specifically was saying on the call, they're urging everyone to look at currency-neutral growth.
So they're saying ignore the exchange rate.
They're arguing that if you strip away that noise, the core engine is still running.
Crawford called it a solid performance. Do you buy that? Is that fair? Or is that just corporate spin to cover up the shrinkage?
It's a little bit of both, to be honest. Look, their return on equity, the ROE, is sitting at 11.7%. For an insurer, that's respectable.
Okay.
Capital metrics are strong. So the solid comment holds water financially. But you can't ignore the fact that even without the currency issue, they are facing some serious headwinds. It is not just the yen.
Okay, so let's fly across the Pacific and look at where those headwinds are coming from. Let's talk about Japan. I think a lot of casual listeners forget that Aflac is basically a Japanese company that happens to have its headquarters in Georgia.
It is huge.
Yeah.
Japan is their bread and butter. It's their engine room. And this quarter, The Japan data gave us a perfect example of what we call the paradox of growth.
Paradox of growth. I like that title. Break it down for me.
So looking at the sales data, specifically new annualized premium, it looks amazing. Yeah. Sales jumped 15.7% in the fourth quarter in Japan.
Wow.
They did nearly 20 billion yen in new sales.
Nearly 16% growth in a mature, aging market like Japan. That sounds incredible.
It is.
Usually insurance growth there is flat or barely moving. What on earth are they selling?
They are crushing it with a product called Miraito. It's a cancer insurance product. And this connects directly to the strategy shift CEO Daniel Amos has been talking about for a while.
Okay.
They are aggressively, and I mean aggressively, targeting new and younger customers.
Because their legacy customer base is, well, aging out.
Exactly. They need fresh blood, literally.
Yeah.
They have Miraito for cancer. They have a product called Sumitasu, which is a first sector protection product.
Pause there. First sector. That sounds technical. Define that for us quickly so we're all on the same page.
Sure. In Japan, the insurance market is regulated into sectors. First sector is basically life insurance protection against death. Third sector is the medical stuff cancer, hospitalization. Aflac is historically the king of the third sector.
Got it.
Sumitasu is them playing in that first sector space, offering a savings-type insurance to get younger people in the door.
Okay, so they're branching out. And they also launched something called Anshin Palette in December.
Right, a new medical policy. So the sales machine is working, the marketing is working, young people are buying these policies. That is the growth part of the paradox.
So what is the paradox? If sales are up that much, everything should be great.
The paradox is that despite selling almost 16% more new policies, the net earned premiums, the actual cash coming in from their entire customer base, fell 1.9%.
That feels completely counterintuitive. How do you sell more but earn less?
It comes down to a concept called paid-up policies. This is crucial to understanding Aflac's current struggle.
Okay.
Imagine you bought a cancer policy 20 years ago. The deal was pay us premiums for 20 years, and then you're covered for the rest of your life for free.
Okay, I follow. Like paying off a mortgage. Stop paying the bank, but you keep the house.
Exactly. Well, a massive chunk of Aflac's older customers in Japan have now reached that 20-year mark. They've stopped paying premiums. So the revenue from those thousands of customers just drops to zero overnight.
But Aflac still has to insure them.
Correct. The liability remains, but the income stops. This is the drag on the revenue. That old block of business is shrinking and paying out less cash faster than the sales team can bring in new cash with Miraito.
So they're running up a down escalator.
That is the perfect analogy.
And I imagine running up that escalator isn't free.
It's very expensive. Look at the expense ratio in Japan. It jumped to 22%. That is up 120 basis points from last year.
And why the jump?
Because acquiring new customers costs money. You have to pay commissions to brokers, you have to run digital ads for Anshin Palette, you have to do marketing campaigns to convince a 25-year-old they need cancer insurance.
Right.
So you have this brutal dynamic. Revenue from old customers is vanishing. Expenses to get new customers are rising.
And that squeezes the margin from both ends.
Exactly. Japan is a volume story right now, but it is not a profit margin growth story.
So that is the situation in Japan. A sales boom masking a revenue drag. Let's bring it back home. What's happening in the U.S.? Is the duck flying any better domestically?
The U.S. is almost the inverse of Japan. Here, they are actually seeing real revenue growth. Net earned premiums are up 4% to $1.5 billion.
Okay, so 4% growth is decent. Not explosive like a tech stock, but it's positive.
It's healthy. Sales increased 3.1%, largely driven by group voluntary products. That's the stuff you sign up for during open enrollment at your job.
Right.
But there was one number in the U.S. report that really stood out to me as a sign of underlying strength.
What's that?
The persistency rate. It came in at 79.2%.
Persistency is just insurance speak for retention, right? How many people stick around?
Yes. It means almost 80% of their customers renewed their policies. In the insurance game, that is the holy grail.
It's the lifeblood.
It is. If you have to replace half your customers every year just to stay flat, you'll go broke on marketing costs. Keeping 80% means you have an incredible base of recurring cash flow. Yeah. It's sticky revenue.
Okay, so the customers are loyal. But I notice a red flag in the U.S. numbers, too. We have to talk about the benefit ratio.
The ouch point, yes. The benefit ratio, which is the percentage of every premium dollar that goes back out the door to pay claims, widened to 48.6%. That is up 230 basis points.
That's a huge jump. Nearly half of every dollar they take in is going out to pay for someone's claim. Are Americans just getting sicker?
It's partly that. They noted higher claims activity in individual voluntary policies and group life and disability. So, more people got sick or passed away than they forecasted. But it's not just sickness. There's a strategic element here, too.
Meaning they choosing to take a hit.
In a way, they're intentionally spending more to scale up new business lines. They're moving aggressively into network dental and vision and direct-to-consumer.
Dental and vision, everyone offers that. That seems like an incredibly crowded market to try and elbow your way into.
It is a shark tank.
Yeah.
You have huge incumbents. So to break in, Aflac has to build networks of dentists and optometrists, and they have to price their premiums competitively, maybe even aggressively, to win contracts.
So they're trading margin for market share.
Precisely. And you can see it in the profit margin. The pre-tax profit margin in the U.S. dropped from 19.7% last year to 17.4% this year.
Wow.
They're basically saying, we will accept lower profitability today to own a bigger piece of the dental and vision pie tomorrow. It's a land grab.
It is a land grab, but it means the days of, 20% plus margins in the U.S. might be on pause for a while.
I think so.
So let's zoom out a bit. We have Japan fighting gravity with these paid-up policies. We have the U.S. sacrificing margin for growth in dental. Profitability is down. Revenue is technically down. And yet, looking at the capital allocation, this company is moving cash around like it is going out of style.
This is the part that fascinates financial engineers. Despite all those headwinds, Aflac is an absolute cash cannon.
We mentioned the yen earlier. I want to circle back to enterprise hedging. It sounds like something from Star Trek, but it seems important here.
It is vital. Aflac knows the yen is volatile. So they structure their debt and their investments to act as a buffer. If the yen crashes, the value of their yen liabilities also effectively drops in dollar terms. They have these hedges in place to smooth out the noise.
So it protects the real value of the company, even if the quarterly accounting report looks messy.
Exactly. It protects the economic value.
Speaking of investments, I know a lot of listeners have been nervous about commercial real estate. We've seen the headlines about empty office towers crushing regional banks. Did Aflac take a hit there?
Surprisingly, they dodged that bullet completely. Zero charge-offs in commercial real estate.
Zero. That's hard to believe given the market.
Zero, which speaks of very conservative underwriting. They aren't holding the risky debt on empty skyscrapers. They did take a small $22 million hit on middle market loans. But to put that in perspective, their portfolio is worth tens of billions.
So $22 million is a rounding error.
It is. In fact, they had net investment gains of $537 million.
So the investment portfolio is healthy. And that brings us to the capital return story. This is what the dividend investors care about.
This is the highlight reel. In the fourth quarter alone, just 3 months, Aflac bought back $800 million of its own stock.
$800 million in one quarter. That is aggressive.
And if you look at the full year of 2025, they bought back $3.5 billion.
That is a massive amount of equity to retire. They're just shrinking the share count to prop up the earnings per share number.
Right. And on top of that, they raised the dividend. They just hiked the Q1 2026 dividend by 5.2%.
And that streak is getting long, isn't it?
43 consecutive years. Aflac is a dividend aristocrat.
So let me play devil's advocate here. Net earnings are down, margins are squeezing in both Japan and the U.S., but they're buying back billions in stock and raising the payout. Is this sustainable?
That is the central debate. It's the definition of a mature cash cow. They don't need to reinvest every single dollar into building new factories or R&D like NVIDIA. They generate so much excess cash that even after paying for the expensive growth in Japan and the dental rollout in the U.S., they still have billions left over.
It's a sign of strength, but also a sign of maturity. They literally can't find enough places to invest that $3.5 billion inside the company to get a better return, so they just give it back to shareholders.
Exactly. It's capital discipline. If they wasted that money on a bad acquisition, investors would revolt. Buying back stock is the safe, predictable play.
So what does the future hold? We're here in February 2026. What is management telling us to expect for the rest of this year?
Frederick Crawford gave us a pretty clear roadmap, and honestly, it is a sober one. For Japan, they're being very honest. They expect premiums to continue declining. They're forecasting a 1% to 2% drop in 2026.
So the gravity of those old paid-up policies falling off is still stronger than the lift from the new Morido sales.
For now, yes. The math just works out that way. They're fighting a very strong current.
And in the U.S.?
In the U.S., they are more optimistic. They expect continued growth somewhere in the 3% to 6% range. But, and this is the key, they warned that margins will stay tight, around 17% to 20%.
Because they're going to keep spending on that dental and vision expansion.
Correct. They are not taking their foot off the gas. They are committed to the pivot.
There was one other acronym that popped up that sounded very technical. PCAP. What is that?
The PCAP facility. It stands for Pre-Capitalized Trust. It's basically a piece of financial engineering that acts as a catastrophic safety net.
Okay, in English.
Think of it like a massive credit card that they haven't activated yet. It sits there ready to go.
Yeah.
If we hit a major recession or another global pandemic and liquidity dries up, Aflac can tap this facility to get instant cash.
So it's a doomsday bunker full of money.
Essentially, between that PCA facility and their actual cash on hand, they have about $4.1 billion in what they call unencumbered liquidity.
That is a lot of dry powder.
It sends a signal to the market. Don't worry about us. No matter what happens with the economy, we can pay our claims and we can pay our debts.
So putting it all together, Aflac Q4 2025. What is the big picture takeaway here for you?
The big picture is transition. Aflac is in a bridge period. They are successfully proving they can sell new products. Morido and Anshin Palette are legitimate hits in Japan. They're proving they can grow the top line in the U.S., but both of those efforts are expensive.
The easy money era is over.
The days where the old block of business just printed money on autopilot are gone. Now they have to hustle. They have to spend money to make money. They are grinding.
They're grinding. And while they grind, they're keeping investors happy with these massive buybacks and dividends.
Right. Fundamentally, the company is incredibly strong, huge capital ratios, huge liquidity, but the growth story is going to be slow. It's not a hockey stick graph.
It sounds like they are doing the right thing strategically, but it is going to take time for the financials to catch up to this new reality.
Exactly.
You have to be patient while the new sales eventually outpace the old runoff.
So here's the final thought for you listening today. We see a company shrinking in some ways, growing in others, and spending billions to buy its own stock.
Right. And that raises the provocative question we should end on.
Exactly. With premiums shrinking in Japan and margins shrinking in the U.S., is that aggressive $3.5 billion share buyback program a sign of supreme confidence? Is it them saying, we are so undervalued, this is the best purchase we can make?
Yeah.
Or is it actually a defensive admission? Is it an admission that they simply don't have any high-growth opportunities to invest in?
Mm-hmm.
If they had a way to invest that $3.5 billion into a new product that would generate a 20% return, wouldn't they do that instead of buying back stock?
That is the multi-billion-dollar question. Are they buying back stock because it's the best option or because it's the only option?
Something to chew on. Is the buyback a flex or a white flag? We will let you decide. Thanks for joining us on this deep dive into Aflac's Q4 2025. We will see you next time.